Hello guys, welcome back to my channel. If you're new here, this is where we break down money, business and economics in simple terms so you can understand how the financial world really works. Today we're asking a big question. What is a recession? You've probably heard news anchors, politicians or friends use the word, but what does it really mean? Why does it happen? And how can you protect yourself when it does? Let's break it down. So first let's start off with the definition of a recession. What actually is it? Now there are two ways to think about a recession. One way is the technical definition. A recession is when the economy slows down for an extended period. The technical definition is 2 or more quarters of negative GDP growth. Now what does that mean? GDP stands for Gross Domestic Product, and it is basically the value of everything a country produces from goods, services, and business activity. Imagine the economy as a car driving on a highway. When the car slows down for months, that's a slowdown. But when it brakes hard for half a year or more, that's a recession. Now the second way to think about a recession is how it feels. A recession is when regular people like you and me stop feeling rich. People lose jobs, investments drop, and families worry about money. It's a tough time for everyone. Now that you know what a recession is, let's move on to how it happens. Why do recessions occur? The truth is there isn't just one cause of a recession. Usually it's a combination of factors. So there are 4 main causes of a recession, and we'll go through each one briefly. Now, 1. High inflation. We've talked about this a lot recently. When prices rise too quickly, people buy less. Think about going to the grocery store. Last month bread was $2, now it's $3. Over time, families need to cut back. Businesses sell less and the economy slows down. High inflation means people have less money to spend on everything else. And that's what causes a recession. No. 2. Rising interest rates. Again, something we've covered a lot on this channel. To fight inflation, central banks, which are institutions like the Federal Reserve here in the U.S., raise interest rates. That makes borrowing money more expensive. Mortgages, car loans, and business loans all cost more. So fewer homes are sold, fewer cars are bought, and businesses pause expansion plans. Think about buying a home. If interest rates double from 3% to 6%, suddenly your monthly payment is much higher and you can't afford the house anymore. When that happens, fewer people take out mortgages, which causes the housing market to slow down. No. 3. Global crises. Wars, pandemics, or oil shocks. These crises disrupt economies around the world. For example, in 2020 when COVID-19 hit, shops closed, planes stopped flying, and millions lost their jobs almost overnight. That's what happened in 2020, and that's what caused the recession. And no. 4. Bubbles bursting. When a market gets too hot, it can overheat and eventually collapse. The 2008 housing crash is a clear example of this. Too many risky mortgages led to a bubble, and when it burst, banks collapsed and the entire economy crashed. So those are the 4 main causes of recessions. Now that you know what causes recessions and what they are, let's talk about what happens when a recession occurs. What are the effects? How does it impact us? Well, recessions have real impacts on everyday life. So let's go through some of the key effects of a recession. No. 1. Job losses. Companies want to save money, so they lay off workers. Imagine someone packing up their desk after a layoff. Notice they put their personal items into a box. Number 2. Business closures. Small shops close because customers stop spending money. Think about a local coffee shop. If no one's buying coffee, they'll eventually run out of business. Number 3. Falling investments. Stocks and bonds drop in price. The stock market loses value. Retirement funds lose money. People who invested in stocks lose money. And number 4. Consumer fear. Families become more careful with their money. They tighten their budgets and avoid big purchases. A recession impacts everyone, from individuals to governments to large companies. Now that you know how recessions impact us, let's look at some real-life examples. This will help you see how recessions work in practice. We'll cover two major examples of recessions and how they impacted the world. The first one is the 2008 global financial crisis. At the beginning of the 2000s, housing prices started rising too fast. People kept buying bigger and bigger houses, pushing up prices even further. But this wasn't healthy for the economy. Many people didn't have good credit, but they still wanted to buy houses. So banks created new types of loans called subprime mortgages. These loans were very risky, but banks didn't care because they could make lots of money from fees. Everyone wanted to buy a house, so this type of loan seemed like a great idea. However, when housing prices stopped rising and people started defaulting on their loans, the whole system collapsed. Banks went bankrupt and the whole economy crashed. The Great Recession lasted for nearly 5 years and affected every country in the world. People lost their homes and their jobs, and nobody was safe from the crisis. The second example is the 2020 COVID-19 pandemic. When the coronavirus hit, governments ordered lockdowns. That meant businesses had to close, people couldn't travel, and global trade slowed down. Suddenly, shops, airlines, and restaurants weren't making any money. That caused massive job losses and huge losses for investors. But governments around the world worked quickly to stop the damage. They gave people and businesses free money. They lowered interest rates and promised to buy corporate bonds. All of these actions helped prevent a worse recession. So those are two major examples of recessions and how they occurred. Now that you know how recessions happen, let's discuss how you can spot them coming. How can you tell if a recession is on the way? Well, economists watch out for warning signs that tell them a recession is coming. So we'll go through 5 common signs that indicate a recession. First is when the stock market drops. If investors lose confidence in the economy, they sell their stocks, which makes stock values fall. No. 2. When unemployment rises. If more people lose their jobs, it's a sign that the economy isn't doing well. No. 3. When people spend less money. If businesses say that customers aren't buying, that's a sign that the economy is slowing down. No. 4. When interest rates rise quickly. If central banks are raising interest rates to fight inflation, it's a sign that they believe the economy is overheating and a recession might be coming. And number 5, when oil prices spike. Oil is a key resource for many countries. If the price of oil goes up too much and stays there, it can cause a recession. Now that you know the warning signs of a recession, let's talk about how to protect yourself when one hits. How can you keep yourself and your money safe? Well, there are 4 ways to protect yourself against a recession. The first is by building an emergency fund. Having some money saved can help you pay your bills if your income drops. Think about it like this. If you have a car accident and can't work for a few weeks, having an emergency fund can help you pay your rent and buy groceries. That's how an emergency fund helps you. The second way to protect yourself is by avoiding debt. During tough times, people struggle to pay off their loans. That's why high-interest loans are so dangerous. If a recession hits and you lose your job, you don't want to be paying off a bunch of different loans. No. 3. Diversify your income. Having multiple sources of income makes you more resilient. So if one source stops coming in, you have other sources to rely on. You can diversify your income by starting a side hustle, freelancing, or learning a valuable skill. And no. 4. Invest smart. Don't chase risky investments or get drawn into speculative investments. Instead, focus on safer assets like government bonds or solid companies. Recessions are a normal part of the economic cycle. They're not fun, but they don't last forever. By following these tips, you can prepare yourself and come out even stronger. Remember, knowledge is power. Stay informed and stay prepared. If this video has been helpful, please leave a comment below and let me know which part stood out to you the most. And don't forget to subscribe to my channel for more clear and simple videos on money, business, and economics. Until next time, stay curious.